The Emperor's Phone. If Marcus Aurelius opened a trading app in 2025, imagine this. It's early morning in Rome. The streets are quiet, the air still heavy with the night's silence. Marcus Aurelius, the philosopher emperor, the man who once commanded the mightiest empire on earth, opens his eyes. But instead of hearing the shuffle of sandals or the clash of swords, he hears the buzz of a notification. On his marble desk lies not a wax tablet, but a smartphone. He taps the screen and suddenly the markets of 2025 come alive. Green and red candles dance like the flames of torches. Headlines scream, AI stocks surge 40% overnight. Crypto collapses by 2 trillion. Recession risk rises as rates hit decade highs. The emperor, who once faced barbarian invasions, plagues, and political betrayal, now stares at another battlefield, the battlefield of modern finance. And here's the question. What would he do? Would he chase the next hype coin? Would he panic when a stock fell 30% in a week? Would he jump into every hot pick promised by gurus? No. He would whisper to himself the same words he wrote nearly 2,000 years ago. You have power over your mind, not outside events. Realize this, and you will find strength. And why this matters to you. You see, in 2025, the noise is deafening. The AI boom has minted billionaires overnight, but also bankrupted thousands who bought too late. Crypto cycles are more violent than Roman gladiator fights. Up 400% one year, down 80% the next. Central banks are raising rates, inflation bites, housing is unaffordable, and news pundits scream doomsday every hour. If you're an investor, you probably felt it. Fear of missing out when friends brag about their gains, or panic when your portfolio bleeds red. You scroll, you compare, you stress. But Marcus Aurelius shows us a different way. His wisdom, distilled through meditations, isn't just philosophy, it's an investment framework for 2025. A calm, proven path where the focus shifts from predictions to principles, from noise to rules, from hype to habits. It's a shocking truth. Here's a number that should shock you. According to Dalbar's research, the average equity investor in the U.S. underperforms the market by 34% per year, not because of bad stocks, but because of bad behavior. They buy high, sell low, and chase fads. Over 20 years, that gap means losing hundreds of thousands of dollars compared to simply staying disciplined. That's not a market problem. That's a mindset problem. And Marcus Aurelius would tell us, the impediment to action advances action. What stands in the way becomes the way. The obstacle is not the market. The obstacle is ourselves. And we're sure you are a story of two investors. Let me tell you a modern story. Investor A checks his portfolio 20 times a day. He reads Twitter threads at midnight. He switches from Tesla to Nvidia, to Bitcoin to Solana, always chasing the rocket that's about to launch. Some days he makes quick gains, but more often he buys high and sells low. After 5 years, he's exhausted, anxious, and barely ahead of inflation. Investor B takes another path. She creates a simple plan. Save 25% of her income, invest monthly in a few broad funds, keep 10% for high upside bets she studies deeply, journal every decision. She doesn't panic when markets fall, she buys more. After 5 years, she is calm, growing wealth, and most importantly, free from anxiety. Who do you think Marcus would admire? The gambler chasing the winner, the stoic who builds quietly, brick by brick. Why storytelling matters. This video is not about stocks to buy next week. It's about rewiring how you see money itself. Because money without mastery is slavery. And mastery begins not in the market, but in the mind. Think of Marcus Aurelius walking into today's New York Stock Exchange. Traders scream, screens flash, chaos reigns. He'd probably smile faintly, then write in his journal, "To be disturbed by loss is the same as being disturbed by change. Yet change is the nature of the universe." That's the calm we need in 2025. Your role in this story. So here's my invitation. Don't just watch this video, practice it. After each of the 9 Stoic investing rules we'll cover, we'll give you a journaling cue or small exercise. Do it. Pause, write, reflect. Because wisdom unused is wasted. This is your training ground. The market is the battlefield. Your habits are your armor. Your rules are your shield. A practical warm-up. Do this now. Take a pen right now. Draw 2 columns. Column 1, things I control in my financial life. Column 2, things I don't control. In column 1, write how much I save, my spending choices, my asset mix, my behavior. In column 2, write daily prices, Fed decisions, Twitter predictions, market noise. This is your first Stoic portfolio, a portfolio of mindset. Guard it well. The promise of this journey. By the end of this video, you will have a 9-rule Stoic investing framework for 2025, a barbell portfolio model, defense plus courage, practical routines, checklists, and exercises you can use tonight, a mindset shift from chasing predictions to mastering principles. And yes, you'll feel something unusual in finance videos. Peace. Because true wealth is not just numbers in your account, it's the ability to stay calm while others panic, to stay disciplined while others chase hype, to know what's enough while others are never satisfied. Shepa could read some final words of the hook. So I ask you, if Marcus Aurelius could survive betrayal, wars, and plagues while writing words that still guide us today, can you survive a 20% market drop without losing your soul? Stay with me. For the next hour, we will step into his mind and together, we'll build not just portfolios, but lives of freedom. Because the Emperor's wisdom, combined with your discipline, can make you unstoppable in 2025. Part 1, the dichotomy of control portfolio. East, the marketplace of noise. Picture a scene. Rome, the center of the ancient world. The marketplace is bursting with noise. Merchants shout, coins clink. Fortune tellers promise wealth to anyone willing to pay. Buy this amulet, the god's favorite. Trade these spices, tomorrow they will double. Fast forward 2,000 years. It's not the Roman Forum anymore, it's your social media feed. Tweets scream, this AI stock is the next trillionaire maker. This meme coin will 100x by next month. The marketplace of noise hasn't disappeared. It has just changed platforms. Marcus Aurelius would not be surprised. He once wrote, everything we hear is an opinion, not a fact. Everything we see is a perspective, not the truth. And so in the middle of this chaos, he would open his wax table tour in our time, a spreadsheet, and divide it into 2 columns. Column 1, what I control. Column 2, what I don't control. Why this split is everything. Here's a shocking truth. Most investors spend 90% of their energy obsessing over column 2, things they cannot control. Market crashes, Fed announcements, political drama, Elon Musk tweets. And yet none of these are within our hands. Meanwhile, the few who focus on column 1 savings rate, risk allocation, discipline quietly build fortunes. Warren Buffett put it bluntly, the stock market is designed to transfer money from the active to the patient. Patience is an act of control. The psychology of control. Psychologists call this the locus of control, whether you believe outcomes are shaped by external luck or internal actions. Investors with an external locus blame markets, politicians, or luck. Those with an internal locus build habits, rules, and processes. A 2019 study in the Journal of Behavioral Finance showed that investors with an internal locus of control were 25% more likely to stick with long-term strategies, and their returns outperformed by nearly 3% annually. Marcus would recognize this instantly. His entire Stoic philosophy rests on one line. You have power over your mind, not outside events. Realize this, and you will find strength. In other words, your portfolio is your mind. And the strongest portfolio is one built only with what you can control. A modern example, let's take 2 real investors. Investor A, external focus. O checks CNBC 5 times a day. O jumps into crypto after it's already up 300%. O panics when the S&P 500 drops 10%, sells everything. O blames manipulation when he loses. After 10 years, his portfolio barely beats inflation. Investor B, internal focus. O automates 20% of her paycheck into index funds. O keeps 6 months of cash aside. O allocates 15% to high upside opportunities she researches deeply. O ignores daily noise, rebalances once a year. After 10 years, she not only beats inflation, she builds true freedom. Same markets, different locus of control, different lives. Inakunaduashan, just what Marcus Aurelius would write in 2025. Imagine him, stylus in hand, writing in his journal, I cannot control whether Bitcoin is 20K or 200K. I can control whether I put 10% of my portfolio in it or 90%. I cannot control whether interest rates rise. I can control how much debt I carry. I cannot control the greed of others. I can control whether I follow them. That is the Stoic dichotomy of control applied to wealth. Building the dichotomy portfolio. So how does this translate into a practical portfolio for 2025? Let's break it down. Things you can control. Column 1. 1. Savings rate. Decide to invest 20% of your income, or more if you can. 2. Asset allocation. Choose percentages e.g. 60% defense, broad funds, bonds, cash, 20% courage, crypto, AI, 20% human capital. 3. Risk tolerance. Define max 10% of net worth in high volatility bets. 4. Rules for rebalancing annually or when drift, 20%. 5. Your behavior. Whether you panic or stay calm, things you cannot control. Column 2. 1. Short-term market moves. 2. Headlines, tweets, pundit predictions. 3. Timing of crashes or booms. 4. What others do. 5. Random luck. The lesson? Column 1 is your edge. Column 2 is your doom. A famous story, The Turtle and the Hare. In 1983, a trader named Richard Dennis ran the famous turtle trader experiment. He gave a group of novices a simple set of trading rules: risk management, position sizing, discipline. Within 5 years, many turned small sums into millions. Why? Because rules are controllable. Predictions are not. It's the same lesson Marcus would teach. The hare chases noise, the turtle follows rules, and the turtle wins. Tamaki wonder what are the power of checklists. Airline pilots use checklists for one reason: humans panic. In emergencies, memory fails. The checklist saves lives. Investors need the same. Create your Stoic investor checklist. Did I size my position to survive a 50% drop? Do I understand the business or protocol? Is this decision based on my plan or on fear, FOMO? What is my pre-written exit plan? Print it. Tape it to your desk. Because when panic hits, philosophy without action is useless. Case study 2020, crash. Let's rewind to March 2020. The S&P 500 fell 34% in 1 month. Panic was everywhere. Millions sold at the bottom. Yet those who stuck to a simple dollar-cost averaging plan, DCA, not only recovered, they doubled their money by 2021. Why? Because they focused on what they could control, continuing contributions, while ignoring panic headlines. Marcus would nod. He wrote, "Do not disturb yourself by picturing your life as a whole. Take it day by day, moment by moment, day by day, contribution by contribution." A practical exercise. Do this now. Grab paper. Create 2 columns. Column 1, things I control. Column 2, things I don't control. Now fill them in. Be honest. Income, partially in your control, through skills, work. Spending, yes, fully in your control. Stock prices tomorrow? No. Allocation to stocks versus cash? Yes. Federal Reserve policy? No. Your emotional response to Fed policy? Yes. Circle column 1. Commit. I will build my wealth only with these tools. A Stoic mantra for investing. Here's a mantra you can repeat before every financial decision. I control my inputs. I do not control outcomes. It sounds simple, but simplicity is the ultimate sophistication. The emotional payoff. When you master this dichotomy, something changes. Stress decreases, anxiety fades. You stop refreshing prices every 10 minutes. You sleep better, you live better, and ironically, your results improve. Because money grows in silence while you live your life. That is the true wealth Marcus wanted, not endless numbers, but inner peace. Clutch the closing words for part 1. The first step to investing like Marcus Aurelius in 2025 is not buying Bitcoin, not timing AI stocks, not predicting recessions. It's drawing 2 columns and committing to one truth. You are responsible for your process, not the market's outcomes. The marketplace of noise will never vanish, but with the dichotomy of control, you can walk calmly through the chaos like an emperor who knows that fortune favors discipline. Part 2, Character Before Capital. With a legion's secret picture, a Roman legion, thousands of soldiers stand in formation. Their swords glint in the sun, their shields interlock like a wall of iron. To an outsider, their strength looks like steel. But Marcus Aurelius, watching from the command tent, knows the truth. It isn't the swords that win wars. It's discipline. A soldier without discipline is just a man with a sharp piece of metal. But a soldier drilled, trained, and committed to habit, that man is unstoppable. The same is true for investors. It is not capital that builds wealth, but character. Check the modern illusion. Today, most people believe that money itself creates wealth. If only I had $101, then I could invest properly. If only I had a big inheritance, then I'd be rich. But here's the shocking truth. Most lottery winners lose it all. A study from the National Endowment for Financial Education found that 70% of lottery winners are broke within 5 years. Why? Because they had capital but no character. Marcus Aurelius would not be surprised. He wrote, "A man's worth is no greater than his ambitions, and in investing, your worth is no greater than your habits." The habits. Build, luck destroys. Think of 2 investors again. Investor A starts with $500,000 from inheritance. He trades aggressively, buys meme stocks, chases hype. Within a decade, half of it is gone. Investor B starts with just $5,000 and a modest salary. She automates saving 20% every month, invests consistently, resists lifestyle creep. After 20 years, she not only surpasses Investor Ash has built $1 million portfolio. This isn't fiction. Studies confirm it. Vanguard's 2022 report showed that investors who automate contributions are 42% more likely to stay invested during downturns. Meanwhile, those who manually time contributions often miss the best day, costing them up to 2% annually. Character, capital, always. Or to the Stoic view of wealth. The Stoics never measured wealth in coins. For them, wealth was freedom from slavery to desire, to fear, to fortune. Seneca once wrote, "It is not the man who has too little, but the man who craves more, that is poor." Marcus Aurelius echoed, "Very little is needed to make a happy life. It is all within yourself in your way of thinking. So if you cannot master yourself, no amount of money will save you. But if you master yourself, even modest sums will grow into freedom." Here's practical habits. The 4 shields. Let's translate this philosophy into investing. Here are 4 Stoic shields you can build around your wealth. 1. Pay yourself first. Automation beats willpower. Before bills, before spending, a fixed percent of your income goes straight to investments. Even 10% compounds into millions over decades. Example, a 25-year-old saving $500 a month at 8% average return retires with 1.5 millionaires by 65. 2. Lifestyle break. When income rises, don't inflate lifestyle fully. Invest at least 50% of the raise for the first 12 months. This simple habit alone can add hundreds of thousands to your net worth. 3. No leverage for speculation. Compounding is fragile. A 50% drawdown requires 100% return to break even. With margin, that loss can wipe you out permanently. Remember Archegos Capital, 2021? A 10B fund collapsed overnight because of overleverage. Wealth without discipline, warm ashes. 4. Sleep test sizing. If a position keeps you awake at night, it's too big. Marcus would say, "It is not death that a man should fear, but never beginning to live." Don't let fear of money stop you from living. Size so you can sleep. Case study, Buffett versus traders. Warren Buffett started investing at 11 with $114. By the time he was 30, his net worth was about $1 million. But here's the shock. 99% of his wealth came after age 50. Why? Compounding plus character. He stuck to habits for 70 years. Contrast that with traders who made millions in the 2021 crypto boom and lost it all in 2022. They had capital but no character. Buffett's wealth is proof. Discipline beats luck. The temptation of the crowd. Marcus once said, "The opinion of 10,000 men is of no value if none of them know anything about the subject." Think about social media. Thousands shouting, "Buy this coin, sell that stock." But if none of them have a disciplined plan, why follow them? Your wealth is not built by crowd noise. It is built by your private character practiced in silence. Crush the training of the mind. Just as a legion trains daily, so must investors train. Write down your rules. Review them monthly. Practice restraint when tempted by hype. Celebrate discipline more than profit. Marcus wrote, "Waste no more time arguing about what a good man should be. Be one." Likewise, waste no more time debating strategies. Be disciplined. For your thought experiment. Imagine you suddenly inherit $1 million tomorrow. What would happen? If you lack habits, that money will evaporate. If you have habits, it will multiply. Now imagine the opposite. You inherit nothing, but you build habits. Saving, investing, discipline. After 30 years, you will still likely surpass the careless millionaire. The conclusion is clear. Character is the real inheritance. We reckon on numbers that prove it. Let's run the math. Investor without habits starts with one member but spends 5% more than income annually. After 20 years, his wealth shrinks to less than $400K. Investor with habits starts with $0 but saves $1,000 a month, invests at 8%. After 20 years, she has $600K plus. After 30 years, 1.3M plus. Character beats starting capital every single time. With a practical exercise. Here's your task. Step 1. Write down your top 3 money habits right now. Step 2. Ask, do these habits build wealth or erode it? Step 3. Choose one habit to automate this week. Example, every payday, auto transfer 15% to index fund. Then comment it below. Declare it publicly. Discipline grows when shared. Emotional impact. When you anchor wealth in character, stress decreases. You stop fearing market moves. You no longer depend on luck. Instead, you depend on yourself. And that is the greatest freedom of all. Closing words for part 2. Capital is fragile. Character is compounding. The world chases quick wins, meme stocks, lottery tickets. But Marcus Aurelius would remind us, the happiness of your life depends upon the quality of your thoughts. Your thoughts become your habits. Your habits become your wealth. So remember, it is not the sword that wins the war. It is the discipline of the soldier. And in investing, it is not the dollars that create wealth, but the character behind them. Part 3, time is the strongest ally. The dawn in the emperor's camp. Picture Marcus Aurelius at dawn. The camp is still. Soldiers stir quietly, preparing for another day at the frontier. Marcus sits alone, journal in hand, candle flickering. He writes, "Time is like a river, made up of the events which happen in a violent stream. For as soon as a thing has been seen, it is carried away, and another comes in its place. To him, time is not an enemy. Time is the only ally that never betrays." If Marcus were alive today, staring at a chart of the S&P 500, he would remind us, you don't need to outsmart time, you need to partner with it. The illusion of speed. Modern investors are obsessed with speed. How fast can I double my money? Which stock will 10x this year? But speed is fragile. It crashes when the road bends. The average day trader loses money. A 2019 study of Brazilian day traders found that 97% lost money after 300 days, and only 1% earned more than a modest salary. They chased speed, and speed betrayed them. Contrast that with investors who held broad index funds for decades. Despite wars, crashes, inflation, the U.S. stock market has delivered about 10% annualized returns over the last 100 years. It wasn't clever timing. It was time itself. And the mathematics of patience, let's run the math. $10,000 invested at 8% grows to $21,189 in 10 years. Leave it for 20 years, $46,710. Leave it for 30 years, $100,626. Notice the first 10 years made $11,189. The last 10 years made $54,016. Time doesn't add wealth, it multiplies it. Albert Einstein allegedly called compound interest the eighth wonder of the world. Whether he said it or not, the math proves it. Compounding works only for the patient. Marcus would nod. No man is more unhappy than he who never faces adversity, for he is not permitted to prove himself. Markets test patience through adversity, but patience turns adversity into profit. The story of Ronald Red. Consider Ronald Red, a janitor and gas station attendant in Vermont. His salary was modest, never above average. Yet when he died in 2014, he left behind $8 million. How? He lived frugally, invested in blue-chip stocks, and most importantly, held them for decades. He partnered with time. Compare him to high-paid athletes who earn $100 million and go bankrupt within years. Capital without patience evaporates. Small sums with patience multiply. A Stoic view of time for the Stoics. Time was not something to waste chasing pleasures. It was a resource to be guarded. Seneca warned, "It is not that we have a short time to live, but that we waste much of it." Marcus added, "Do not act as if you were going to live 10,000 years. Death hangs over you. While you live, while it is in your power, be good." Applied to investing. Stop wasting time predicting tomorrow. Use time as your ally by compounding today. Understand the 50% rule. Here's a practical rule Marcus might adopt in 2025. If I cannot hold this asset through a 50% decline, I will not buy it. Why? Because history guarantees such drops. S&P 500 fell 86% during the Great Depression. It fell 48% in 1973-74, 57% in 2008. Bitcoin dropped 85% in 2018. Yet in every case, those who held through decades made multiples on their capital. Time, not timing, was the ally. The sleep test of time. When you size your positions for the long term, ask, can I sleep at night if this asset drops 50% and stays down for 3 years? If yes, you own it. If no, it owns you. This is how time becomes your friend instead of your tormentor. Antoine case study, $10,000 in the S&P 500. If you invested $10,000 in the S&P 500 in 1980 and held until 2020, you'd have about $700,000 despite crashes, wars, 9/11, recessions, political chaos. But if you missed just the 25 best days out of 40 years, your wealth would be cut in half. And those best days almost always came right after the worst days, which means selling in fear guaranteed missing the rebound. Marcus would say, the impediment to action advances action. What stands in the way becomes the way. The very crashes we fear are the seeds of future growth. The temptation to act. Humans hate waiting. We want to act, do something. But in markets, doing nothing is often the hardest and smartest move. Think of Odysseus tied to the mast, resisting the sirens. The sirens of investing are breaking news, urgent tips, once-in-a-lifetime trades. To survive, you must tie yourself to the mast of time. Your mast is your written plan. The rule of rebalancing time also requires maintenance. Marcus Aurelius trained daily, journaling every morning. Similarly, your portfolio needs regular review. A simple rule: rebalance once a year or when allocations drift more than 20-25%. That's it. No need to check daily. It's like pruning a tree. Small adjustments, long growth. If the emotional dividend patience pays not just in money, but in peace. Investors who trade constantly experience higher cortisol, stress, even health issues. Studies from Cambridge University show active traders have cortisol spikes similar to soldiers in combat. Meanwhile, long-term investors sleep better, live longer, and ironically, end up richer. Practical exercise. Here's your practice for this part. 1. Write down one asset you own or want to own, e.g. S&P 500 fund Bitcoin. 2. Ask, am I willing to hold this for 10 years through at least one 50% crash? 3. If yes, size it responsibly. If no, cut it or size it smaller. Write this in your journal. This is how you ally with time. A story to remember. In 1976, John Bogle launched the first index fund. People mocked him. They called it Bogle's folly, but time proved him right. Today, index funds hold over $11 trillion globally. Millions of ordinary investors owe their wealth to one man's belief in patience. That's the lesson. Let others laugh. Time will vindicate you. Closing words for part 3. So what would Marcus Aurelius do with time? He would not try to outrun it. He would walk beside it. He would size positions to survive 50% drops. He would write rules before storms. He would ignore the marketplace of noise. And above all, he would trust compounding because time, not talent, builds empires. Time is a sort of river of passing events, and strong is its current. No sooner is a thing brought to sight than it is swept by and another takes its place. Marcus Aurelius. Let time sweep away the noise. Let your discipline remain. Part 4, the Stoic Barbell. Defense plus courage. Shields. Before spears on the battlefield, a Roman soldier never led with his sword. He led with his shield. The shield protected him, his comrades, and the formation itself. Only when the line was steady did the spear thrust forward. Marcus Aurelius knew this truth. Defense always comes before courage. Protection first, then risk. In modern investing, this is the same principle. Most people chase the spear-high returns, moonshots, lottery tickets without building the shield. They win a battle or two, but lose the war. The barbell philosophy. In Stoic thinking, balance is not about averaging everything in the middle. It is about embracing extremes wisely. Strong defense plus bold courage. Nassim Nicholas Taleb, author of Anti-Fragile, calls this the barbell strategy. Put most of your resources in safe, resilient assets. Put a small portion in high-risk, high-upside bets. Avoid the fragile middle. Marcus would have approved. He wrote, if you seek tranquility, do less, or do what's essential with a natural flow. The barbell simplifies your life. Defense gives tranquility. Courage gives upside. Why most investors fail. Here's the shocking truth. The average retail investor tries to live in the fragile middle. They don't hold enough cash to survive a storm. They overexpose to risky assets, but not enough to win big. They panic when things fall, then FOMO back in when it's too late. J.P. Morgan's 2022 report showed the average investor returned just 2.9% annually over 20 years, while the S&P 500 delivered over 8%. Why the gap? Bad defense and bad courage. Study the defense side. Shields of Stone. Marcus would begin with protection. What shields must you hold in 2025? 1. Emergency cash, 612 months. Oh, life throws plagues, wars, pandemics. Without cash, you sell at the worst time. Oh, a Federal Reserve survey, 2022, found that 37% of Americans cannot cover a $400 emergency. That's not wealth, that's slavery. 2. Core equity index, 40-60%. Oh, history shows equities build wealth long-term. Broad funds like the S&P 500 or global indexes have beaten inflation for over a century. Oh, example, $10,000 in the S&P 500 in 1990 grew to $208,000 by 2020. 3. Quality tilt, 220%. Oh, not all equities are equal. Companies with strong cash flows, low debt, and durable moats tend to endure. Think Johnson & Johnson, Microsoft, Procter & Gamble. 4. Bonds or T-bills, 10 or 20%. In 2025's uncertain rate environment, short-term treasuries yield 45%. These are shield steady, predictable. The courage side, spears of fire. Once protected, Marcus would permit courage. But courage is not recklessness, it's targeted risk. 1. Crypto core, 5-10%. Assets like Bitcoin, digital gold, or Ethereum, digital infrastructure. Volatile, yes, but asymmetric upside. Example, $1,000 in Bitcoin in 2015, over $300,000 at its 2021 peak. 2. AI and compute infrastructure, 5-10%. Instead of chasing every new AI startup, own the shovels in the gold rush. Semiconductors, NVIDIA, AMD, energy for data centers, cybersecurity. 3. Personal ventures, human capital, 5-10%. Marcus valued self-mastery. In 2025, that means courses, skills, distribution. A $5,000 skill investment could add $50,000 income per year. Avoiding the fragile middle. What's the fragile middle? Chasing safe but low-yield savings accounts. Inflation eats them. Going all in on speculative bets. One wipeout destroys you. Over-diversifying into 50 random stocks without understanding any. The fragile middle is death by mediocrity. Defense plus courage is strength. Case study, the 2020 crash investor. A had no shield. 90% of his wealth was in growth stocks. When COVID hit, he panicked, sold at the bottom, and locked in losses. Investor B had shields, cash, bonds, broad equity. She used courage wisely, added to Bitcoin and AI during the crash. By 2021, her courage doubled, her shields endured. Same storm, different shields, different outcome. Historical wisdom. Think of Rome itself. The empire lasted not because it always won battles, but because it built defenses, roads, walls, legions. Courage alone collapses, defense sustains. Marcus wrote, "The art of living is more like wrestling than dancing. Investing too. Wrestling requires defense and counterattack, not just wild moves. Hallours, a practical Stoic barbell for 2025. Example allocation. Educational template, not financial advice. Defense, 70%. 50% equity index fund, global diversified. 10% short-term treasuries. 10% cash buffer, 612 months. Courage, 30%. 10% crypto core, BTC, ETH. 10% AI compute infrastructure. 10% human capital, personal ventures. This barbell is anti-fragile. If markets crash, shields protect you. If new tech booms, courage rewards you. Stoic exercises, exercise. 1. The shield journal. Write down, what is my shield? What protects my family if I lose my job, if markets fall 50%? Exercise 2. The courage test. Ask, if this bet goes to zero, will I still be safe? If yes, take it. If no, shrink it. Exercise 3. The barbell map. Sketch your current portfolio. Label defense percent versus courage percent. Which side is weak? Strengthen it. Arshinam. Usikwanig emotional mastery. With a barbell, you gain emotional calm. You know your shields protect you. You know your courage has upside. You no longer fear volatility, you welcome it. Volatility becomes your sparring partner, not your enemy. Closing words for Part 4. Marcus Aurelius would never send soldiers into battle without shields, nor should you send your money into markets without defense. At the same time, he would not shrink from risk. Courage, targeted, limited, asymmetricists, what expands empires. So in 2025, the Stoic investor builds a barbell, shields of stone, defense, spears of fire, courage. That balance is tranquility. That balance is wealth. If you are distressed by anything external, the pain is not due to the thing itself, but to your estimate of it. And this you have the power to revoke at any moment. Build shields, wield spears, walk calmly through the battlefield of markets. Part 5. Simplicity over cleverness. The Emperor's Lesson in War. Marcus Aurelius once faced a dilemma. His generals suggested elaborate strategies: flank from the north, send cavalry through the marshes, surprise at night. But Marcus knew the truth. The more complex the plan, the greater the chance of failure. So he chose simplicity: fortify the camp, guard the supply lines, wait for the enemy to weaken. And he won. If you seek tranquility, do less. Or do what's essential with a natural flow. Marcus Aurelius. In investing, as in war, complexity is seductive but dangerous. Simplicity is boring but victorious. The modern trap, cleverness addiction. Walk into any financial forum in 2025, and you'll see cleverness everywhere. Here's my 37-step option strategy for AI stocks. This DeFi protocol yields 400% APY if you bridge across 3 chains: stake here, farm there. I discovered a secret arbitrage between futures and perpetuals. Sounds smart, feels smart, but most end in losses. JP Morgan once studied institutional investors. The more complex their strategies, the lower their long-term returns. Simplicity outperforms because simplicity endures. Karulakerson showed the numbers behind simplicity. Consider this shocking stat. Morningstar 2022 found that over 90% of actively managed funds underperform simple index funds over 15 years. Why? Complexity. Higher costs, more mistakes, more turnover. Simplicity, because low costs, steady compounding. Warren Buffett famously bet $1 million that a simple S&P 500 index fund would beat hedge funds over 10 years. He won. The index fund returned 126%, the hedge funds just 36%. Cleverness lost, simplicity won. Here's the Stoic way: clear, few, essential. The Stoics prize clarity. Seneca warned against being everywhere as being nowhere. Marcus echoed, ask yourself at every moment, is this necessary? Applied to investing, do I need 50 different assets? Or just 5 strong ones? Do I need to trade daily? Or invest monthly? Do I need to predict the future? Or simply prepare for it? The fewer decisions, the fewer mistakes. Let's cover the story of John Bogle. In 1976, John Bogle launched the first index fund. Wall Street laughed. They called it Bogle's Folly. Who would buy a fund that just accepts average? But over time, it crushed most managers. Today, index funds control over $11 trillion globally. Millions of ordinary people are wealthy because one man believed in simplicity. That's the Stoic way. Ignore mockery, trust principles. Ashananawan, complexity feeds ego, simplicity feeds wealth. Why do people chase complexity, ego? They want to feel smarter than others. But Marcus warned, it is not death that a man should fear, but never beginning to live. Chasing clever trades is not living, it's gambling. Living is freeing your mind with a simple system, then spending your time on family, health, meaning. Simplicity frees. Cleverness enslaves. Sorry, Cookie. You're checking a simple 3-fund portfolio? Jack Bogle once suggested the lazy portfolio: total U.S. stock market fund, total international stock market fund, U.S. bond fund. That's it. 3 funds. Simple, low-cost, globally diversified. Over 40 years, such a portfolio beats the majority of professionals. Their case study. 2 engineers, engineer A, builds a complex 15-asset crypto portfolio, trading constantly, bridging, staking, chasing narratives. After 3 years, half of it is gone. Engineer B automates 20% of income into a simple 3-fund portfolio. Never checks daily prices. After 3 years, modest but steady growth and peace of mind. Who is wealthier? The one with more peace. Firstly, practical exercise. Write your current investments on paper. Now ask, what if I cut this in half? Would I lose diversification or just complexity? Simplify until what remains is clear, controllable, and essential. The emotional payoff with simplicity, anxiety fades. You no longer chase news. You no longer fear missing out. You no longer explain complicated schemes. You simply say, I invest automatically in simple, proven assets. Then I live my life. That is true wealth. Should a Stoic mantra repeat before investing? Clarity over complexity, simplicity over cleverness. To closing words for part 5. In 2025, cleverness is abundant. Everyone has a secret strategy, but wealth belongs to the calm, the simple, the disciplined. Marcus would say, waste no more time arguing about what a good man should be. Be one. So waste no more time chasing clever tricks. Be simple. Be disciplined. Be free. Because in the end, the emperor's wisdom is this: simplicity scales, cleverness fails. Part 6, Discipline as Wealth. Heir to the emperor's daily ritual. Every morning before the council met, before the armies moved, Marcus Aurelius sat down with his journal. He wrote not about glory or conquest, but about discipline. At dawn, when you have trouble getting out of bed, tell yourself, I am rising to do the work of a human being. He understood that discipline was not chains, it was freedom. Without discipline, an emperor is a slave to whims, pleasures, and fear. With discipline, even a poor man can be rich in peace. So what would Marcus say to investors in 2025? That your true wealth is not measured in dollars, but in discipline. Why discipline outperforms intelligence? Most people think investing is about intelligence, predicting trends, spotting patterns, outsmarting others. But studies show it's discipline, not IQ, that determines success. A University of Berkeley study tracked thousands of investors. Those with higher IQs but poor discipline often underperform those with average IQ but strong habits. Vanguard data revealed that the single most powerful factor in investor success is staying the course, not timing, not picking. Marcus would nod. You have power over your mind, not outside events. Realize this, and you will find strength. Strength in markets is not cleverness. It is the ability to keep going when others give up. The tragedy of genius investors. History is full of brilliant people who lost fortunes because they lacked discipline. Take long-term capital management, LTCM. In the 1990s, it was run by Nobel Prize winners. They created the most complex trading models in the world. And yet in 1998, the fund collapsed, losing $4.6 billion in a few months. Why? No discipline, too much leverage, too little humility. Compare that to Ronald Read, the janitor, who quietly saved, invested, and died, worth $8 million. No PhD, no hedge fund, just discipline. Genius without discipline collapses. Discipline without genius compounds. The 3 pillars of financial discipline. Marcus would divide discipline into 3 pillars. 1. Discipline of saving. Pay yourself first. Always. Even 10 days saved becomes $109,000 in 30 years at 8%. Without saving, there is no capital to invest. 2. Discipline of holding. The market will tempt you to panic. Discipline is holding through storms. Example. During the 2008 crisis, those who sold lost 57%. Those who held recovered within 5 years and doubled later. 3. Discipline of rules. Write them down. Follow them. Automate them. Example rules. Never invest more than 10% in speculative assets. Rebalance annually. Never borrow to speculate. The pain of lack of discipline. Let's imagine investor A. He plans to invest $500 monthly, but he skips 1 month to buy a new phone, then another month for a vacation. Then he panics and sells during a dip. After 20 years, instead of $300,000, he has just $150,000. Now imagine investor B, same income, same markets, but she never skips. She automates, she ignores panic. After 20 years, she has $300,000 plus. Same conditions, different discipline, different life. The Stoic training, discipline as muscle. The Stoics trained daily. They fasted, journaled, endured hardship voluntarily, not to suffer, but to strengthen discipline. Seneca wrote, "It is not because things are difficult that we do not dare. It is because we do not dare that things are difficult." In investing, discipline is built the same way. Small acts daily, automate saving. Write one reflection before trading. Resist one impulse purchase. Every act is a rep in the gym of discipline. The cost of indiscipline, the FOMO tax, consider the FOMO tax. When you chase hype, you pay dearly. Example, many bought Dogecoin near 0.70 in 2021. Within a year, it collapsed by over 90%. A $10,000 bet turned into $1,000. Why? Lack of discipline. Following noise, not rules. Meanwhile, disciplined investors who dollar-cost averaged into Bitcoin or index funds still came out ahead long-term. FOMO is not free. It charges the most expensive tax of all lost years. The freedom of automation. One way Marcus might practice discipline today is automation. Set your bank to auto-transfer 20% into investments. Automation turns discipline from willpower into default. Studies show that employees with auto-enrollment in retirement plans save 50% more than those who opt in manually. Automation is stoicism for money. It removes the emotion, leaving only principle. A modern story, Sarah the teacher. Sarah earns a modest salary teaching. At first, she doubts she can invest, but she sets an auto transfer of $300 each month. She ignores the market. 20 years later, she has nearly $180,000. Not by being clever, not by timing, but by being disciplined. Now compare to her colleague Mark, who earns more but never saves consistently. At 50, he has little to show. Sarah with discipline is freer than Mark, with talent but no control. Stoic exercise. Here's your challenge. 1. Write down your top 3 financial impulses, e.g., panic selling, overtrading, impulse spending. 2. Next to each, write one Stoic discipline rule to counter it. O panic selling, I will not sell unless I need cash for survival. O overtrading, I trade only once per month. O impulse spending, I wait 24 hours before purchases $100. Practice this for 30 days. Track progress. Emotional wealth. When you master discipline, you gain more than money. You gain calm. No more checking prices 20 times a day. No more panic at every headline. No more envy when others brag. You walk steady like Marcus through the battlefield, focused, calm, untouchable. You have power over your mind, not outside events. Realize this, and you will find strength. Strength, chakra, discipline, discipline, wealth. Closing words for part 6. Money without discipline is sand through fingers. Discipline without money becomes money over time. In 2025, the markets will scream with hype, fear, and greed. But Marcus Aurelius would remind you, wealth is not measured in your bank balance, but in your ability to stay disciplined when others fall apart. So remember, discipline is not a tool. Discipline is the wealth itself. Part 7, the inner citadel. Emotional resilience. Going to the fortress. Within, in the winter of 170 AD, the Roman Empire was under siege. Germanic tribes raided from the north, plague spread across the cities, and famine threatened the provinces. While generals panicked, Marcus Aurelius turned inward. He spoke of the inner citadel, a fortress inside the mind that no army could breach. A man's true delight is to do the things he was made for. Nothing external can harm you, unless you allow it. This was not poetry, it was survival. And in investing, the storms of markets demand the same. Build your inner citadel, or be destroyed by fear and greed. These markets attack the mind first. The financial battlefield is psychological. Prices rise and fall, but it is the mind that breaks. In 2008, global markets fell 57%. But the bigger loss? Investor panic. Many sold at the bottom, locking in destruction. In 2021, crypto soared. Greed overtook reason. Millions bought at the top, only to see 90% losses. Markets test emotional resilience. Those without an inner citadel fall with every rumor. Those with it stand like stone. The Stoics shield against fear. Fear whispers, sell now before it gets worse. But Marcus would answer, You have power over your mind, not outside events. Fear is external headlines, red charts, angry pundits. Control is internal, your rules, your plan. A Vanguard study found that investors who sought advice, an anchor of resilience, were 3% richer annually than those who acted emotionally. The difference was not skill, but calm. Each of the siren song of greed. On the other side stands greed. It whispers, double down, borrow more, you're missing out. In 2021, Dogecoin rocketed 15,000%, many mortgaged homes to chase it. By 2022, 90% of that value vanished. Seneca warned, it is not the man who has too little, but the man who craves more, that is poor. The inner citadel protects against greed as much as fear. It's building emotional resilience. 3 walls, Marcus would tell us. A citadel needs walls. For investors, there are 3. 1. The wall of preparation, a journal your if, then rules before storms hit. Example. If markets fall 40%, I will rebalance, not sell. Preparation replaces panic with protocol. 2. The wall of perspective, remember history. Every crash in modern times has recovered. The Great Depression, dot-com bubble, 2008, all brutal, all temporary. Write this above your desk. This too shall pass. 3. The wall of practice, resilience is trained. Simulate losses. Ask, if my portfolio fell 30%, what would I do? Practice small exposures, like cold showers or fasting. The mind grows stronger through chosen hardship. Chokwe study, the investor who didn't break, consider Jack. In March 2020, markets fell 34% in weeks. Friends panicked. Jack remembered his journal rule. Continue my auto investment, even in downturns. He stayed calm. He invested every month. By the end of 2021, his portfolio had doubled. Jack's edge was not intelligence. It was resilience. Neuroscience of calm modern science confirms Marcus's wisdom. Stress floods the brain with cortisol, narrowing focus, pushing fight-or-flight reactions. That's why panicked investors sell low. Meditation, journaling, even slow breathing reduce cortisol. A 2018 Harvard study showed that just 10 minutes of daily mindfulness lowered stress by 25% and improved decision-making. Marcus practiced this nightly, writing his fears, reframing them. Today we call it journaling. Then it was Stoic practice. Practical Stoic exercises. Exercise 1. Pre-market journal. Before looking at prices, write, no outcome today can harm me unless I choose to let it. Exercise 2. The 24-hour rule. When tempted to act on emotion, buy or sell, wait 24 hours. Most urges pass. Exercise 3. The volatility rehearsal. Imagine your portfolio down 50%. Visualize calmly rebalancing. Repeat monthly. Train resilience like a muscle. The price of no citadel without resilience. Even wealth collapses. Athletes earning $100 go bankrupt within years. Traders with fortunes lose everything in one cycle. Not because of lack of money, but lack of control. Marcus warned, you could leave life right now. Let that determine what you do and say and think. To live fully is to build the citadel now, not later. Emotional wealth, the true dividend. The greatest dividend of resilience is peace. Imagine waking up, seeing markets down 20%, and still enjoying breakfast with your family. That is freedom. When others panic, you breathe. When others rage, you journal. When others chase, you wait. That calm is worth more than millions because it lets you enjoy millions without slavery to them. So to Yui. Chusher closing words for part 7. Marcus Aurelius built his inner citadel in times of plague, war, and chaos. We face volatility, inflation, bubbles, and crashes, but the principle is the same. Nowhere can man find a quieter or more untroubled retreat than in his own soul. So build your fortress. Strengthen the walls. Preparation, perspective, practice. Wealth may rise and fall, but with resilience, your spirit never will. The inner citadel is not just philosophy, it is your portfolio's strongest defense. Part 8, Fortune favors the patient. It's the emperor who waited. Marcus Aurelius ruled during crisis, plagues, wars, betrayals. Yet history remembers him not as a reckless conqueror, but as the philosopher emperor. His greatest victories came not from speed, but from patience. He once wrote, "Time is a sort of river of passing events, and strong is its current. No sooner is a thing brought to sight than it is swept by, and another takes its place." He knew rushing against time is foolish. Flowing with it is wise, and in investing the patient are favored by fortune. The market's cruel joke. Markets reward patience but tempt impatience. During bull runs, greed screams, "Buy more now, it's going to the moon." During crashes, fear screams, "Sell now before it goes to zero." The cruel joke, acting on either short-term emotion destroys wealth. Waiting builds it. Secret the math of patience, let's compare two investors. Investor A chases trends, trades weekly, times the market. He earns 4% annualized after costs. Investor B holds for decades. She earns 8% annualized. That 4% difference sounds small, but over 40 years, Investor A turns 100K into 480K. Investor B turns it into 2.2 million. Patience quadrupled her fortune. The fortune numbers show the Oracle of Omaha's secret Warren Buffett, one of the richest men alive, calls patience his superpower. The stock market is a device for transferring money from the impatient to the patient. Over 99% of Buffett's wealth came after his 50th birthday. Why? Because patience plus compounding need time. The Stoic parallel. The Stoics taught endurance, not excitement. Epictetus said, "No great thing is created suddenly, any more than a bunch of grapes or a fig. If you tell me that you desire a fig, I answer you that there must be time. Wealth, like figs, needs seasons." A case study, Amazon investors. If you bought Amazon at IPO in 1997 for 10K and held by 2022, it became $16 million. But here's the shock. Along the way, Amazon fell more than 90% during the dot-com crash. Most investors sold. Only the patient became millionaires. Patience, she earned fortune. Crypto, the ultimate test of patience. Bitcoin rose from 0 to 1 to $69,000. But to enjoy that fortune, you had to endure. A drop of 93% in 2011, a drop of 85% in 2018, a drop of 77% in 2022. The impatient quit. The patient built fortunes. Why patience is so rare. Modern life destroys patience. We binge shows, order food in minutes, scroll feeds in seconds. This impatience bleeds into investing. Yet Marcus Aurelius warned, "If you are distressed by anything external, the pain is not due to the thing itself, but to your estimate of it." The pain of waiting is not real, it's your mind's estimate. The Stoic discipline of waiting. Marcus would teach waiting not as weakness, but as mastery. Wait to buy until after research. Wait through downturns without panic. Wait decades for compounding to bloom. Patience is not passive, it's active endurance. In the dividend of patience, impatient investors live in stress, checking prices hourly, fearing every headline. Patient investors live in peace. They know storms come and go, but their discipline endures. Peace itself is wealth. Practical exercises. Exercise 1. The 10-year test before buying. Ask, would I hold this for 10 years if the market closed tomorrow? If not, don't buy. Exercise 2. Delay gratification. Each month, postpone one purchase for 30 days. Train patience in life to train it in money. Exercise 3. Journal of waiting. Write one event you are waiting for. Market rebound, investment maturity. Reframe waiting as progress, not pain. A modern story. The patient nurse Linda, a nurse, invested 200 months in index funds from age 25 to 65. She never stopped. At retirement, she had nearly 1 million, despite never earning more than 60K a year. Her brother, chasing hot stocks, ended with far less despite higher income. Linda's secret wasn't genius. It was patience. The price of impatience, Fidelity once studied its best-performing accounts. Shockingly, the top performers were those of investors who forgot they had accounts because they never traded. Impatience is expensive. Patience is profitable. Closing words for Part 8. In 2025, the world screams now, faster, more. But Marcus Aurelius would remind us, fortune does not favor the quick, it favors the patient. No great thing is created suddenly. Epictetus. So build your fortress of patience. Endure the storms. Let time do its work, because wealth is not taken by force. It is granted by time to those who wait. Part 9. The Legacy of Wealth, Beyond Money. The Emperor's Reflection. Near the end of his life, Marcus Aurelius walked the halls of the imperial palace in Vienna. He had gold, power, legions at his command. Yet his meditations reveal no obsession with riches. Instead, he wrote, "What we do now echoes in eternity." He knew his true legacy was not coins in the treasury, but the strength of Rome's institutions, the justice of his rule, and the wisdom passed to his son. In the same way, modern wealth is not just numbers in an account. It is the life you live, the values you teach, the peace you leave behind. The limits of money studies show that beyond a certain point, around $75,000 per year in the U.S., adjusted for inflation, $100,000 in 2025, more income does not significantly improve happiness. Why? Because after needs are met, wealth without purpose feels empty. Think of celebrities with millions but broken families, addictions, despair. They had money but left no legacy. Marcus would remind us, it is not what you endure, but how you endure that matters. Legacy is not what you own, but how you lived. Kunasumo wan shorwash wealth has responsibility. Money is a tool. In the wrong hands, it corrupts. In disciplined hands, it builds. Andrew Carnegie, once the richest man in the world, gave away 90% of his wealth-building libraries, universities, foundations. Chuck Feeney, co-founder of Duty Free, gave away $8 billion in his lifetime, dying with less than $2 million. These men understood, the purpose of wealth is not accumulation, but contribution. Tanaka Fashik, the Stoic view of legacy. The Stoics believed in virtue as the highest currency. Seneca wrote, "What you leave behind is not what is engraved in stone monuments, but what is woven into the lives of others." Marcus lived this. He did not care how historians judged him. He cared how Rome survived after him. So for us, what legacy are we building with our wealth? Beyond inheritance, teaching habits. Many dream of leaving money for children, but without wisdom, that money becomes poison. Statistics show that 70% of wealthy families lose their wealth by the second generation and 90% by the third. Why? Because they inherited money but not discipline. The best inheritance is not cash. It is habits, discipline, and values. Directly in was modern case study, Warren Buffett's children. Warren Buffett pledged to give most of his fortune to charity, not his children. Why? He said, "A very rich person should leave his kids enough to do anything, but not enough to do nothing." Buffett knew, true legacy is freedom plus responsibility, not luxury without purpose. The hidden dividend of impact. Imagine this. You die tomorrow. Will people remember your portfolio balance or the lives you touched? If you funded scholarships, generations of students live better. If you built a business with integrity, employees thrive. If you modeled discipline and patience, your children inherit resilience. This is the hidden dividend impact compounding through people. Practical Stoic legacy building. 1. Define your values. Write your top 3 virtues, e.g., integrity, discipline, generosity. Ask, do my financial choices reflect these? 2. Plan your contribution. Choose one area, education, health, environment. Direct a portion of your wealth time here. 3. Teach, don't just give. Involve children in investing conversations. Show them how to save, not just what they will inherit. 4. Model simplicity. Live by example. If you show discipline, they will follow. The emotional legacy money fades. Buildings crumble, but emotional legacy lasts. Did you live with courage? Did you stay calm in crisis? Did you treat others with respect? Marcus Aurelius is remembered not for his net worth, but for his meditations, the thoughts of a man striving to live with virtue. Your journal, your actions, your words may be the same for those you leave behind. A story of two fathers, father. He leaves his children $1 million but no guidance. Within years, the money's gone, family fights erupt, and bitterness remains. Father B leaves $100,000 but also decades of lessons on saving, investing, and living with discipline. His children multiply the money and pass the habits on. Who left the greater legacy? The Stoic call to action, Marcus would say, wealth is not for showing off, but for building something that outlives you. Do not act as if you were going to live 10,000 years. Death hangs over you. While you live, while it is in your power, be good. To be good with money is not just to grow it, but to guide it to ensure it serves more than yourself. Practical exercise. Tonight, write a legacy letter. Imagine you could leave one page for your children, students, or loved ones. In it, write the principles you want them to carry on. This may be worth more than any dollar amount. To Redino on the closing words for Part 9. In 2025, the noise says, get rich, spend, show off. But Marcus Aurelius whispers across time, true wealth is legacy. Your investments will grow, shrink, rise, and fall. But the habits, virtues, and impact you pass on will echo in eternity. So ask yourself, what fortress am I building? What garden am I planting? What wisdom will live after me? Because money ends, legacy multiplies. Marcus Aurelius left us wisdom, not predictions. And today you've seen how his timeless philosophy can guide your money, your discipline, your patience, and your legacy in 2025 and beyond. Know it's your turn. Choose one rule from Marcus Aurelius that spoke to you today. Write it in the comments. Not two, not three, just one. Because the power of Stoicism is not in hearing wisdom, but in living it. And if you found value in this journey, remember, hit like, so this message reaches more seekers. Share it with a friend who needs calm in the chaos of money. And subscribe to join our Stoic family, where ancient wisdom builds modern wealth step by step. Because remember, fortune doesn't favor the clever or the quick. Fortune favors the patient. And wealth, true wealth, is discipline, resilience, and legacy.